Yeah. So, uh, can you all see the screen and see my mouse as it's moving around?
Yes.
Okay. So, as usual, if there are any questions, ask them as we go along. Don't wait for the end. Just interrupt and ask what you want to ask. The main topic tonight is like proper calculations for a BRR project and property portfolio. So we're going to run through reasonably fast what a BRR project is and the different steps. And then we're going to look at how to analyze some of the figures. And then very specifically, we're going to look at this is an important topic for people that have already got properties, like got a property portfolio, is like understanding what that income that portfolio is generating. And I'm going to introduce like a principle that I use from time to time, is to actually understand within for example, a property that someone might already have, how much money is actually latent in that property. So if you were to sell that property, pay the capital gains tax if there's capital gains tax to pay, or corporation tax, and release money from that, and then reinvest it, then yeah, the question is it good to keep, or is it a good idea to sell and to do something that's more profitable? I think my camera's disappeared, actually. Just one moment. Can you see me or not?
No.
Strange. Just a second.
But the slide has changed over.
Yeah, I think I'm using my phone for the camera and it's linked to my computer, and
Okay.
somehow something went wrong. Just a moment. Okay, I'm back again. The quality won't be quite so good, but if you want to see me, you can see me now.
Okay.
Yeah, so overview of the BRR strategy. Some people use more R's than just the BRR. It's just like a mouthful to say when there's too many R's. But in practice, there can be up to 4 Rs. So we're buying a property, and the aim is to buy a property below market value and a property where we can renovate and maybe convert. So we're adding more value than the actual cost of works. So we're renovating, adding our value. We're renting it out to get the money in. Then the next step is refinancing. And when we're refinancing at a higher value than the cost of buying and renovating it, so that we're actually able to release straight away capital from the deal to be able to invest in the next project. And then the key thing there is to repeat. What this means in practice is a lot of, let's say, almost accidental landlords or people that are buying maybe one, two, or three properties might be using this, let's say, standard strategy, which is buying a property. We are quite obviously trying to buy at market value, maybe a bit below market value, getting straight away a standard buy-to-let mortgage on it using a 25% deposit, obviously getting the income and the cash flow from the property. But in this case, the 25% deposit is virtually locked in the deal. That money can't be used then to get a second property. And it's needed to wait in general to accumulate ongoing income, for example, from work or from business, to be able to get another property. Or if it's in an area where there's capital appreciation, maybe after 4 or 5 years. So it's still a fairly long time frame. It might then be possible to refinance at a higher value to get money out. Whereas the alternative is to do this in a much shorter cycle. So here what we're doing is we're buying at a low price, renovating or converting to add value. I say converting, like for example, we might be looking at a 2-bedroom house with big enough bedrooms so we can convert into 3 bedrooms. So the end value again is going to be higher than the cost of converting it into a 3 bedroom. And here we're refinancing based on the new value with the aim of getting most of our money out, so that in practice, if we're doing it really fast and maybe like say hands-on, within 6 months, we can get most of our pot of capital out of this deal and we're ready to invest in the next one. So it's like an accelerated way of growing a portfolio without having to add a massive amount of money into the deal. It's true we talk about all money out deals. In practice, there are some of these, but generally we're leaving some amount of money in. And specifically if we're paying someone else to source a property to renovate it, then maybe, yeah, we'll be leaving some money in there, but we've got started and we're still growing the portfolio. So our first step is to buy. I'm not going to go into all the details there. People, we can share the slides to anyone that is interested to look through the details, and we do full training courses on this as well with like 12 modules, probably 7 or 8 hours of video content. So we're looking to buy below market value and at the same time with a strategy to add value. Next step is renovating and adding value. So obviously there we've decided what we're going to do. We're going to get the builders in and do the project. Again, quite a bit of content here of what to look out for, but that's not the aim of tonight's presentation. Then we're renting it out for ongoing income. I was chatting with Kathleen at the beginning of this call, and Kathleen was saying that she's doing some flips or looking to do flips. Flips can be good, but the thing with a flip is that when you finished it, you've got your profit, but then you're almost like sort of back to the start again, and you haven't got any ongoing income. The aim of the BRR is like to combine the advantage of a flip, where we're doing a project to add value to get some profit in there. But if instead of selling to realize that profit to get the money out to do something else, we're refinancing to get the money out. Obviously, it's not going to be all the money, but at the same time, we've got a property that's in our portfolio. And if we've done that properly, it's generating cash for us every month. And then we're refinancing to recycle the capital. So we're looking at getting 75% loan to value on the end value. Yeah, to get money out. And then the next step is to repeat and to do the same thing. And again, an important thing on this repeat, we can do things like sequentially, like we can find the property, then we can organize if we need finance, organize the finance, then we can get it, and then we can start thinking about finding the builders. When it's all finished, then we can start finding the letting agent or doing it ourselves, and then looking for the next property. If we do it in a sequential way, we're going to take 12 months between from start to getting the next one. If, however, we know that, for example, we've bought the first property, we've completed on it, we've got the keys, we know that hopefully by then we've already organized the builders. The builders are almost ready to go in the property and start the work, so that we know within 2 to 3 months that property will be finished. 1 month before it's finished, we're going to be advertising it or starting seeing how we're going to get the income from it. And also generally at the same time, when we've completed on the first one, we're starting the renovation work. If that's only going to take 2 to 3 months to complete, then we should be already looking for the next property. so that as soon as the renovation is complete, we're also starting the refinance, so that if we're really efficient, we can get it down to 6 months cycles, which means if we're really 6 months, that means 2 properties per year. So after 3 years, that's 6 properties. And when we've got to that stage, either we start doing bigger deals or we like maybe buy 2 at the same time. So yeah, this buy BRR, buy, renovate and refinance to grow rapidly a portfolio. Are there any questions on the overall strategy before we look at some more details of like all the costings of this and what we must not forget when we're looking at the costs?
Trevor, would we be able to get the slides?
Yeah, anyone that asks can get a copy of these slides, yes.
Okay, thank you.
No
Yeah,
question from me.
Yep. Okay, so let's move on to the next part. Yeah, so this is an important question when investing in property. And either we're going to choose a hands-on approach or a hands-off approach. And it's really important to make this decision and like in reality, like sort of stick to it. Either it's hands-on, so that means you're going to be finding the properties, you're going to be sorting out the renovations, you're going to be liaising with builders, you're going to be on there sort of shouting at builders, making sure that everything is done on time, done to the right quality. You'll be looking after tenants or potentially handing it over to an agent, but you'll be choosing and vetting the agent. So either there's the hands-on approach, which also means obviously the hands-on approach, because you're using your time to find properties, you're using your time to go and do visits of potential properties, and then using your time for project managing a renovation. Then you're basically using your time for doing this rather than paying someone who's got the experience to get on and do it. The alternative is the hands-off approach, where you're using sourcers. So these are people that can find suitable properties. Obviously, sometimes that's a bit of a tricky one because there's loads and loads of people that call themselves sourcers because they've paid a few £100 to go on some course. And afterwards, they think that they've got all the experience to be able to find the right properties, put all the deals together and the costings. If you're doing this, use people that've got real experience, that have got their own portfolios, and that can demonstrate that they've got the abilities to be able to do that. And there's actually also a question of compliance of different rules and regulations that property sources should be following. Yeah, so the hands-off is you're finding someone and paying someone to do that work. Generally also doing the project management and basically taking the project from beginning to end, and with you not spending any time at all on it. So you know that within, for example, 6 months, you can be at the point where you're releasing that money to be able to go on to the next property. People often ask, how much does it cost? What's the difference in price? In practice, if you're using a sourcer who's also going to be looking after the renovation, that's going to cost you probably something like £10,000 more than if you're doing everything yourself, because it's going to cost something like £5,000 for the sourcing. And then if the person or maybe an associated person is project managing it through to completion, that's probably going to be an additional £5,000. But then the question is, if that's going to cost £10,000, how much of your time are you going to be using instead of that? And what potentially maybe with your business could you be doing? And potentially you're going to be earning more money than the cost of sourcing and project management. And also at the end, you might not have enough time. So you'll be able to go and do things faster. So yeah, really important to make that decision hands-on or hands-off. And then if it's going to be hands-on approach, then the recommendation is to get training on how to do it. There are different people that do training, and potentially also, if the aim is to really do it fast to scale up portfolio, also consider mentorships. Yeah, so it's a question of time versus money and trade-offs. Any questions on this part? So let's go on to the next one. So here is a question of what are the real costs? And quite often, when you see people proposing deals, you might see maybe half, maybe two-thirds of these costs, but it's really important to take everything into account when doing a BRR project, or the same as if doing a flip. So we've got we break it down into three areas: our purchase costs, our renovation costs, and our finance costs. So our purchase costs is obviously we've got the purchase price, we've got the stamp duty, we've got the sourcing fee if we're using someone to find the properties for us. We've got survey fees. Here in purchase costs, we're not talking about finance. That's if you're going to purchase something with cash. If you're going to be using lending, obviously, we need also to take into account all the finance costs. If we're buying in auction, we've got the auction fees. Auctions can be a really good way of buying properties below market value, as long as in auction you decide on the maximum price and you've done the calculations. And also quite often it's a good thing to buy property that are in auction, but either negotiate a price prior to the auction and get them pre-auction, or the ones that don't sell go and then make an offer after the auction, which can sometimes, or actually quite often, be below the reserve price. And then we need to take into account the costs of conveyancing. So those are solicitors' fees for doing the conveyancing work.
Can I ask a
Then,
question, Trevor, please?
yeah,
The auction calculation and costs, will you be covering that? Would you be breaking that down today?
not today, no.
Okay. Is there going to be a time that you're gonna do that?
I think probably on the YouTube channel there is a one of the presentations which does talk about auction fees,
Oh, okay. All
and
right.
also about and I know that in the BRR course that we have, there's a complete chapter that's
Okay.
all about auctions,
Okay.
because
Oh,
effectively um, probably I would say maybe 70% of what we've bought in auction, or what we've helped investors buy in auction, have been post auction. So
okay.
we're seeing things that don't sell, and then we immediately, well, depends, immediately or sometimes not immediately, because when you immediately do something, that gives you the impression that you're really keen. So obviously
Yeah.
the person selling is going to think we can get the maximum price.
Yes. Okay.
Yeah, because in practice, of course, auction fees, there's the standard fees from the auction house, and then every auction property has got what's called a legal pack, which
Yeah.
is all the specific conditions and things for that property. And sometimes in the legal pack, There can be things like is needed to pay the seller's legal fees, and there sometimes can be a lot of different fees that have to be paid that are
Yeah,
not obvious until you look at everything.
yeah,
But definitely keep in mind, we're looking at like in the auctions at the moment. There was a property that I was looking at. This is a potential commercial to residential conversion in Monmouthshire. And this one, I remember it was on the market about a year ago for 600,000. At the time, we put an offer in at 500,000, which wasn't accepted. And that sale fell through. And it's now in auction with a guide price of 300,000.
wow. Hmm.
So yeah, sometimes it's so we're looking at this again to potentially go and get it for someone.
For 250.
Yeah. Yeah, and we're looking at yeah, there's yeah, sometimes there's some really good deals. At the same time, need to be careful of yeah, checking everything. So we've got our purchase costs, then we got our renovation costs. And quite often when you see yeah, people presenting deals, they'll say, we've seen a local builder and it's going to cost, let's say, £25,000. That's fine. But what about all the professional fees? Because planning, it's at least needed to check that the appropriate planning is in place, or it might be permitted development or no planning at all, but you need to be sure about that. And even if there's no planning, there's building regulations that have to be followed, have to be signed off. It's true, quite a lot of people do BRR projects like renovations, maybe changing a kitchen, adding a bathroom, things like that, without going through building regulations and can sort of, in inverted commas, get away with it. But the thing then is if later you're going to be selling that property, then the person buying is going to say, where are the building regulation certificates? What have you done on it? And that can reduce the price at which the property is sold. And
Yeah,
we actually do that because obviously we know what should be done. We do that sometimes to negotiate lower prices by highlighting to the people selling that they haven't done things properly according to planning, that they haven't done building regulation submissions. So all this, yeah, important to take that into account in the renovation costs. And then often people overlook holding costs during renovation. So if the renovation is going to take 3 months, that means 3 months where you're going to be paying council tax, 3 months where you're paying the insurance, utilities, water bills, etc. And it's important to yeah to take all that into account. And then
yeah.
we've got the yeah, sorry, go ahead.
No, I'm just agreeing with you.
Yeah, yeah. And then the finance costs. So obviously we got the lending itself at whatever loan to value we're able to get. Um, we're not talking in this one really about finance. Then we've got the arrangement fees that we always are always added to the lending. Lenders have admin fees, legal fees, application fees, broker fees. All that needs to be taken into account. It's not just a question of we're borrowing 75% of the value. We need to add all these fees on. Then we have our own legal fees. And when we've calculated all that, we can determine the money that we can actually get out. So these are important ones to take into account, all the costs at the three different stages. Then we need to properly take into account operating costs. Again, we often see adverts which are saying, here's like the gross yield, here's the net yield. The gross yield obviously is what the um, tenant or tenants are paying divided by the value of the property. And then we get the net yield when we take off all the different costs. So in the case of a standard buy-to-let, we've got the landlord insurance. Normally, we're recommending rent guarantee insurance. So that's if the tenant stops paying, we've still got the rental income paid by the insurance. And if it's needed to evict the tenant, that is taken into account as well. We should always have a provision for maintenance. And if we're not going to be self-managing, take into account the agent's fees. And then if it's HMO operating costs, we've got management fees, unless we're self-managing, all the utilities, council tax, internet and TV license, cleaning, because if it's an HMO, either every week or every 2 weeks, we have to have the cleaner in there cleaning all the common areas. Maintenance, yeah, potentially a higher level of maintenance in an HMO. So we need to have maintenance budgets and also to have the insurance. So when doing calculations on a BRR, to understand what the real income is going to be, important to take into account all these things. And we actually have templates that we use where we fill in all those figures to understand if a BRR deal is a good deal or not. In fact, just before this, I'm going to share. No, I'll share my the template at the end, show that. Now we're looking at what I'm calling portfolio evaluation concepts. And there's also often quite a lot of psychology involved in this, and like feelings and sometimes emotions. You've maybe bought a property, you might have spent a lot of time getting it up to the right condition. You might sort of have not very much cash flow from it, but you're thinking, well, I've got it now, I might as well keep it. At the end of the day, it's more important to try and get away from the emotional side of things and get back to the real figures to understand if each property in your portfolio is one that is worth keeping, or whether it's possible to get a better return on the capital that is sitting in that property. It's the same thing when you're doing, for example, stocks and shares. Because I'm not an expert in stocks and shares, I do have small amount. But I'm thinking, look, these shares, they're 90% down on what I bought them for. There's no point in selling them because I'm only going to get 10%. And they might one day go up in value. In reality, that is like a rubbish argument. What I should be doing is understanding, look, if I were to get that remaining money out of my shares, what is the potential of increasing, getting a return on that money? And it should be the same thing in property. And when we're evaluating our own portfolios, and we do actually have a service where we sometimes do this on behalf of investors who want us to look at what they've got and give recommendations. What we're doing is, so obviously for each property in the portfolio, we're looking at the purchase price, including stamp duty, legals, sourcing, etc. Looking at the renovation costs, so we've got an idea of the total money that went into it. That's one thing, but in reality, that's money that's already gone in. And if it's like sort of not a great deal, there's nothing you can do about it. It's just a question of you got that information, you know how much you spent, you know what income you're getting. And that should serve, like, for example, as an example, and a breakdown if you're going to be going to get another similar one. But what we're looking at there is the current situation. So we need to get a proper value of each of our properties, and not based on how much we think it's worth or how much an estate agent came in and told us it's worth, because obviously they want our business to sell it, but a realistic value based on local sold comparables. And yeah, be really honest and realistic about what the value of the property is. So afterwards you're making the right decisions. Also, if you've got a relatively recent mortgage or official valuation, we can use that. Then we're looking about the current mortgage amount that is, so the amount of mortgage that's on there, the amount of lending from the bank, the current mortgage interest rate that we've got, the current loan to value, and then we're looking at the equity. So the equity is the difference between the value of the property. So in other words, between how much we would reasonably get for that property if we were to sell it, not how much we think we can get, how much we could realistically get, and then the mortgage that we have still to pay on it. And then we're going to add the costs if we were to sell it. So let's say, for example, we've got a property that's worth £500,000. We've got a mortgage of 300,000 on there. So that means that we've got equity of 200,000 in there. So if we were to sell that property, we're going to get 200,000 out of it if we're realistic on that. We've got our selling costs, which are like agents' fees, legal fees, etc. And then there's a really important thing. So let's say we get 200,000 profit, and let's say there's 10,000, 5% that's going in sales costs. Then we've got, which actually is taken into account for the capital gains. Then we need to know at what price we purchased the property to understand how much capital gains we're going to pay, or if it's in a limited company, how much corporation tax we're going to pay. And then we're going to get the potential money out. So let's imagine in this one that initially we got 200 equity, 10,000 has gone in cost to sell, and let's say there's going to be 40,000 in either corporation tax or capital gains tax. So we've got 150,000 potential money out. So that means potential money out that we could then reinvest in something else. So what that means is we've got potential 150,000 out. What we need to understand is if that money is staying in the property, we've got the calculation of our cash flow on it. So that's the rental income minus the costs minus the mortgage. And then we can divide that cash flow by the potential money out, which is in reality the return on that capital that we could potentially use elsewhere. So let's imagine that ends up at let's say 10%. We know if we're looking at a BRR that potentially on a good BRR with proper leverage, we can end up getting maybe 15 or 20% return on investment. That means return on the money in. That therefore means that if you only got 10%, it makes sense to sell that property and invest in something that will give us a higher return. Yeah, so it's important to have a systematic approach, proper calculations to decide. Obviously, there's quite a lot of other things that come into play, but to decide and make logical decisions to really optimize our portfolio and get maximum income. So yeah, a bit more on portfolio evaluation concepts. Yeah, so we've got our gross income. So so that's what we get from the tenants. We've got our costs. Then we've got the net income before the mortgage. We've got gross yield and net yield, which are useful figures because we're comparing what are the standard yields in the area where we're operating. We've got our current cash flow. And then we've got what I was saying from the previous slide, our current return on, it sounds a bit of a mouthful, realizable equity after tax. That means potential money out. So we're basically understanding we've got this money that we could use for something else. what return are we getting on that money where it is, to determine whether it's worth taking that money and using it for something else. And then it's true, we should take into account capital growth. So if we're in an area where we've looked at, for example, the investments are going to take place in that area, we've looked at maybe some projections from some of the big property agents or estate agents who might be projecting no income in this, no capital gain in this area, but or in this area a certain percentage. So what we're going to do there is we like to do a 5-year projection. So let's imagine we're thinking of keeping a property. We're going to consider the immediate return on investment on the capital that is employed. And we're going to obviously take the total return of that over 5 years. We're going to consider the potential capital growth over 5 years, and therefore the total return over 5 years. And then we'll simply take that and compare it with other possible deals, which is whenever, for example, we do joint ventures, whenever we're proposing joint ventures to investors, we're giving them the figures. This is how much money you put in. This is what we expect to return when we've completed the development. And then for the money that's left in there, this is what we expect to get over the next 5 years. This is the expected capital appreciation. So that when the investor's considering, obviously these are simulations and estimations, but when the investor's going to come into the deal, he's looking at this 5-year plan and comparing it, for example, with the existing properties. How are they going to perform also over 5 years?
Trevor, for the thank you very much for this. This is very interesting and informative. For the if you're looking at potential capital growth, because it's uncertain, would you put in a, for example, a worst case, mid case, best case, or something like that, or 2 or 3 scenarios?
Yeah, I mean, in reality, because this is more like for comparison.
Okay.
If I'm comparing, for example, with, let's say, a joint venture
Yeah.
in a particular area, and let's say that joint venture is projecting, let's say, for example, 4% capital appreciation per year. I might be thinking, if I've got my own property, I might be thinking, look, if they're saying 4%, my situation is a bit the same. I'm going to use that same projection.
Okay.
So at the end, you're like, you like sort of either you're choosing like a middle route and comparing everything based on that. Because the problem of doing these projections is it's nice to have like minimum expected and best case.
Okay.
But at the end, you end up sort of saturated and too many things to compare.
Yeah. Yeah.
So it's important, yeah, to try and, which is why I really like this, which I call realizable equity after tax. That basically means I set up, this is how much money I'm left with, which I can reinvest. If I invest that in like one of the best deals that I can find now, this is what I'm going to get from it. What do I get if I don't sell the property? And if it's sort of more or less the same, then there's no point in selling.
Okay.
If it's going to be twice the return, and if, for example, especially that's sometimes the case with properties in London where there's high capital costs, and prices aren't sort of increasing that so much now in London, that if we can, if, for example, the realizable equity after tax in a property is, let's say, so that £150,000, and we're getting maybe 500 cash flow because of the high cost of mortgage, then yeah, we could understand that if we were to invest that in some other area, we might get 2,000 of cash flow.
Okay. Thank you very much. And I posted another question in the message, which you might have.
Unfortunately, I'm not looking at that.
Okay.
So please say it.
Yeah. Sorry. I had there were people in the room before, so I didn't want to disturb them.
Yeah, no
but
problem.
they're gone now, so it's fine. So I noticed from news articles that some people are struggling with flats where cladding is an issue, and they're
Yes.
losing money and unable to sell. And I posted a link to a recent news article. Is that a potential opportunity for property investors who have the cash to be able to pay, or who can obtain the cash to be able to pay for the cladding getting replaced, or their share of it, and perhaps buying an unmortgageable property at a substantial discount in cash? Because the article showed somebody was losing money on their flat because of high service charges, as well as
Yes.
being unable to sell it and potentially mortgage it. I didn't finish reading whole article, or is that too risky? That kind of deal
I would
or
say
opportunity.
as long as you're prepared to wait a bit,
Okay.
then, and obviously, and as long as there is a real significant discount,
Yeah.
then that definitely can be a good thing. Because there's two other things that immediately come to mind. One
Yes.
is short leases. So short
Oh
lease
yeah.
properties are unmortgageable.
Okay.
You can get bridge finance, by the way, on them, but they're generally unmortgageable.
Yeah.
And so people, yeah, like a bit afraid, and generally it's possible to get short lease, or generally they're flats, sometimes houses, at a much lower cost than the actual cost of extending the lease.
So
But if someone's never done it before, they're thinking it's going to be complicated, they're going to run into problems.
yeah.
Whereas in practice, if you're using a good solicitor who's done this 100 times before, who knows the law, and also now on short leases, there's no longer the 2-year delay to have to wait before applying to extend the lease.
Okay. And short lease flats are completely unmortgageable, or you can get mortgages which are less than the lease length? Or something like that,
Generally, if it's less than, I think it's 70 years,
okay.
they're unmortgageable on either a standard buy-to-let mortgage or a or a homeowner's mortgage.
Okay. Even if the mortgage is repaid before 70 years, like
Yes,
25-year
yeah,
repayment. Okay.
yeah.
All right.
The
Thanks.
reason for that is, I
Yeah.
think it's the security. So
I
that if,
see.
for example, the person with the mortgage, the owner were to default in the payments and the bank were
Ah,
to repossess, they can't. It's not easy to
it's a
realize that value because
depreciating
yeah,
asset.
no one else wants it. Yeah, and it's depreciating.
Okay. Thank you very much. That's
Yeah.
really
And yeah,
insightful.
basically all these things fit into what we call the BRR, because anything where we can buy significantly below value, deploy a strategy that is without risk. Because yeah, in the case of the things with cladding, it's not going to go on for 20 years.
Yeah.
We know how much it's going to cost. We need to have contingency. So let's imagine the cost is going to increase by 50%. So take that into the calculations just in case. And if it's still a good deal and you're prepared to wait, then yes.
Okay. Thank you. Thank you very much.
Trevor, can I ask a question if you wouldn't mind?
Yeah, of course, yeah.
What I wanted to ask is, have you done short leases yourself? Short lease purchasing?
I've done one where it was a short lease, and we in this case this was like ex council stock, and
Yeah.
there it wasn't extending the lease; it was a question of buying the freehold.
Okay.
So,
All
and I
right.
think it was something like probably 70 years left on the lease. And
Okay.
yeah, and we bought the freehold. It cost us something
Okay.
like £5,000, and the property was probably £15,000 below market value.
Okay. All right.
And these were on properties where the price was around like 80,000. So it's as a percentage, it was like that basically made it a BRR deal, all money out.
Yes. Yes, I understand. Yeah. Thank you.
All right. Are there any other questions?
I've got one more.
Yep.
Do you have a sort of recommendation for a good short lease solicitor on your books at all?
Yes, I don't have one at hand, but I can dig a bit, and yeah, there are ones that probably not ones that I use. It was quite a few number of years ago, but I know ones that yeah, other people have used recently and that sort of specialized in this.
Okay. Yeah, I'd like that, please. That would be nice.
Yeah, okay, no problem.
Thank you.
We haven't really got time. We can do that another time if people are interested to actually show the Excel. Unless if you've got 3 minutes, I'll show you what it looks like.
Yes, please.
Yep. Let's see. If anyone's fed up, then feel free to leave. Yeah, it's just like a couple of minutes to show you this Excel file that we use for analyzing deals. So I'm just trying to find out how to share again. Do you see my screen?
Yes.
Yeah. This one here, the way that this works is we use this ourselves for analyzing deals. And on here, everything that's in pink is what we put in, and everything else is calculated automatically. So for example, we've got property here where the purchase price was 75,000, end value 130, and we always put in the surface area because we're always comparing with comparable surface areas. We plug in our cost of renovation. We take from property filters the average sold prices, and then that basically is going to calculate everything. Because you remember I said that we got stamp duty, sourcing fee, surveys, auction fees, conveyancing, etc. We've got our renovation costs, holding costs, etc. All of that goes in. So for this project, it tells us the total money that we need without finance. We got our end value. And then when we're doing a BRR project, either we've got enough money to fund both the purchase and the renovation, so we don't need finance, and at the end we're going to refinance. Or if you don't have all of that money, we can use bridging at the beginning. Obviously, if you use bridging, there's higher finance costs, so we'll have more money left in. So all these calculations are on, as we're going down here on the left, we've got an example of refinance on completion. Term lending from the purchase. If we're using bridging to purchase and then refinancing after bridging. But all these calculations are automatic. We've got the percentages in there that we use. Unless the rates change, we're not changing that. And that will automatically give us, on a BRR project, on this project, if we buying cash, we're going to end up with £15,000 left in and 24% return on the money left in. And if we're using bridging, we're going to have 22 left in and 16% return. And these figures, by the way, are the figures where you're paying someone to do the sourcing, because these are the templates that we use where we include our sourcing fee, so that an investor knows what is the return on investment that they're going to get. And then we've got separately on separate files the calculations of all the costs if it's going to be a standard buy to let, and we've got a special sheet in there that if it's going to be an HMO, we've got all the HMO calculations in there. And actually we've got a third sheet which, if it's going to be serviced accommodation, how we make the calculations for the income on the serviced accommodation. Yeah, so that's just an overview and a reminder, always do proper calculations and take time from time to time to evaluate how well portfolios are performing and consider doing things with them. Any final questions?
Nothing from me. Thank you very much. That was really informative.
Okay, well, thank you, everyone. This recording will be available on YouTube from tomorrow if anyone wants to look at it again. And if anyone would like the copy of the presentation, just send me a message afterwards and then we'll get it to you.
Thank you so much. Very enjoyable. Thank
Yeah.
you.
Okay, great. Yeah. Well,
Informative.
have a good evening, everyone.
Thank you.
Good evening. Thank you. Bye-bye
Yeah,
all.
yeah. Bye.